Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LANTHEUS Holdings INC quarterly report. LANTHEUS Holdings Inc. provides a wide range of diagnostic and therapeutic products for various diseases worldwide. Some of the key businesses and services offered by the company include diagnostic imaging agents such as DEFINITY, TechNlight, Xeno-133, Neurolite, Cardiolite, and PYLARIFY, Automated Bone Scan Index to detect prostate cancer metastasis RELISTOR for opioid-induced constipation treatment APROMISC, and PYLARIFY, AI medical device software for image analysis radiopharmaceutical therapies such as 1095, PN-TEAT-WO 1002, and PN-TEAT-WO 1000, and 3 PET imaging agents like MK-6240 for Alzheimer's disease and LNT-H-2000. 401 for gastrin-releasing peptide receptor targeting. The company also collaborates with various partners including GE Healthcare, Point, Regeneron, and Ratio Therapeutics, LLC, to develop new products and services. LANTHEUS Holdings Inc.'s stock price plummets. A year of disappointing earnings and market concerns in the past year. LANTHEUS Holdings Inc., NASDAQ, LNTH, has experienced a significant decline in its stock price, dropping by over 39% as of July 2025. The company's quarterly earnings reports have been a major contributor to this decline, with each report revealing disappointing financial results and associated market concerns. The Q3 2024 earnings report was the first sign of trouble, with the stock falling by 20% due to anticipated weak fourth quarter adjusted earnings per share, EPS. This trend continued in Q1 2025, where the company's stock dropped nearly 25% after reporting first quarter results that fell short of analysts' expectations. The situation worsened in Q2 2025, with the company missing both earnings and revenue forecasts. The stock experienced a substantial plunge, dropping 29.07% in pre-market trading and 31.5% intraday. Furthermore, LANTHEUS revised its full-year 2025 revenue guidance downward, citing increasing competitive pressures in its core PSMA PET market. The ongoing securities, lawsuits, and investigations have also contributed to the negative investor sentiment. Multiple law firms have filed lawsuits or initiated investigations alleging securities law violations related to LANTHEUS's prior disclosures. This legal uncertainty has further eroded confidence in the company's leadership and financial prospects, leading to a 29% stock price drop in August 2025. The combination of disappointing earnings reports, market concerns, and ongoing legal issues has resulted in a significant decline in LANTHEUS Holdings, Inc.'s stock price over the past year. The primary drivers of revenue growth or decline for the company can be summarized as follows. Revenue growth drivers. The main contributors to revenue growth are the increase in sales of diagnostic imaging products, expansion into new markets, strong demand for prostate health products, and significant increases in precision diagnostics and PYLARIFY revenues. Additionally, the company's contract manufacturing services and recent acquisitions have also contributed to revenue growth. Revenue decline drivers. On the other hand, the primary drivers of revenue decline are market competition and pricing pressure, a decrease in license and royalty revenues due to strategic partnerships, and a decline in radiopharmaceutical oncology revenue. Other factors contributing to revenue decline include net price compression, loss of market share, and failure to negotiate favorable financial terms with customers. Net income and profit margins experienced significant declines in 2025 compared to the previous year. Net income decreased by 45% from $324,232,000 in YTD 2024 to $179,471,000 in YTD 2025, with a notable drop of $144,761,000. This decline was also evident in quarterly results, where net income fell from $131,093,000 in Q3 2024 to $27,771,000 in Q3 2025. Profit margins suffered as well, with gross profit margin decreasing from 64.1% to 58%, operating income margin dropping from 35.3% to 19.2%, and net income margin falling from 34.6% to 14.5%. The primary reasons for these changes include non-recurring post-combination expenses, increased costs of goods sold and operating expenses due to inflationary pressures, executive management turnover, and prevailing economic conditions beyond the company's control. The company is generating a significant amount of positive operating cash flow. According to the financial summary, in both 2025 and 2024, the net cash provided by operating activities was substantial, with $299,963, or $299,963,000 in 2025, and $387,020, or $387,020,000 in 2024. This indicates a strong ability to generate cash from its core operations, which is a positive sign for the company's financial health. The company's debt level and interest expenses have undergone significant changes. While the total debt decreased from $98.8 million to $942,000 on page 20, long-term debt and other borrowings actually increased from $565.3 billion to $567.9 billion on page 29. Furthermore, the maximum available under the 2022 revolving facility is a staggering $1.44 billion. In terms of interest expenses, there are mixed signals. On page 2, interest expense increased by 0.96% from $4,903 in 2024 to $4,950 in 2025. However, on page 32, the interest expense for the 9 months ended September 30, 2025, remained the same as 2024 at $11.3 million. The company's contingent consideration liabilities related to acquisitions have increased significantly from $0 in 2024 to $97.8 million in 2025 on page 20. Financial Performance Overview. The financial summary reveals mixed results for research and development expenses. On one hand, program third-party research and development expenses saw significant growth, increasing by 100% in the 3 months ended September 30, 2025, and 88% over the same period last year. This indicates strong investment in specific programs. On the other hand, other research and development expenses experienced a decline, decreasing by 16% for the 9 months ended September 30, 2025, compared to the previous year. However, this segment saw an increase of 99% in the 3 months ended September 30, 2025, suggesting some variability in spending patterns. Overall, program third-party research and development expenses performed well, while other research and development expenses showed mixed results with a decline over the 9-month period. Management's outlook and strategy. The company is executing its strategy to become a fully integrated radiopharmaceutical company by expanding its portfolio, pipeline, commercial, development, and manufacturing capabilities. Key initiatives include submitting an NDA for NAV-4694 in 2026, investing in PYLARIFY awareness and adoption, and continuing to hold a significant share of the U.S. market for ultrasound-enhancing agents. Management expects growth from existing products such as DEFINITY and Neurasic, but notes that revenue contribution will depend on increased adoption and utilization of beta-amyloid PET and anti-amyloid therapeutics. The company is also investing in new product development, including clinical trials to determine the effectiveness of products like PYLARIFY for prostate cancer detection. Significant costs are expected in areas such as regulatory approvals, integration of acquisitions, clinical development, commercialization, manufacturing, and intellectual property. Management notes that growth from Neurasic will depend on its ability to clinically differentiate itself from competitive products, and there is a risk that investments in new formulations may not yield expected benefits due to regulatory risks. The company has made significant investments through acquisitions and strategic divestitures. Key acquisitions include the purchase of Evergreen Theragnostics, Inc., for $43,042 in April 2025, and Life Molecular Imaging Limited, for $53,800 in July 2025. These acquisitions demonstrate the company's commitment to expanding its capabilities. On the other hand, the company has also divested its SPECT business to Shine Technologies, LLC, a wholly owned subsidiary of LANTHEUS Holdings Inc., indicating a strategic decision to focus on core operations and shed non-core assets. The company has made significant investments in share buybacks over the past year. Specifically, It repurchased approximately 4.2 million shares under two separate programs for a total cost of $300 million as of September 30, 2025. This demonstrates the company's commitment to returning value to its shareholders through strategic capital allocation decisions. Concerns about inventory buildup or supply chain disruption are evident throughout the financial summary. The limited shelf life of radiopharmaceuticals necessitates just-in-time manufacturing, processing, and distribution, making timely receipt of raw materials and shipment of finished goods crucial. Inventory buildup is a concern due to batch process timing, with projected increases in 2025 compared to 2024. Establishing or amending manufacturing and supply arrangements for commercial supplies also poses costs and risks. Supply chain disruption could have a negative effect on business, particularly if radioactive raw materials are not readily available or if distribution networks are disrupted. The limited sources of isotopes and raw materials used in manufacturing exacerbate this risk. Additionally, potential tariffs and trade policies may further impact supply chains. That concludes the financial summary for LANTHEUS Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.